Okay, well, good morning, everybody. We're going to go ahead and get started. Even if a few more people join, that's okay. We are recording this great conversation that we're going to have with Director Brenda Henson with the Department of Revenue. Brenda and I have been colleagues and friends for a long, long time, and I am so privileged and honored to have her here today. And of course, all the work we've done over the years has been something I'm proud of, Brenda, and I hope you are too. So it's a great privilege to have her. She is, and without a doubt, the most knowledgeable person on property tax issues in this state, and has been such a resource for all of us as these conversations have been, first and foremost on our minds. And down the street at the Capitol, I'm in downtown Cheyenne right now. And how are the impacts facing all of us, not only just us as residential homeowners, but as entities that utilize these tax dollars. And then, of course, the bigger picture on how it all fits in with our tax structure in Wyoming, which we all know is not as well balanced as it could be, just due to our heavy reliance on minerals. So we are excited to have Brenda here today. What we decided to do is have Brenda prepare some slides, and then it's just an open conversation. And so if you have questions, feel free to raise your hand on the Zoom or pipe up. This doesn't have to be formal. I think it's more beneficial if it's conversational. And so just pipe in as we go through this. We will probably have about half an hour, 40 minutes of that kind of conversation. And then we can have a lot more time at the end if folks want to really dig into something there. So before I go ahead and turn it over to Director Henson, I also want to mention that she is, and it's public now, she is retiring from the Department of Revenue. This is the second time she's retired, but I think this one might take, right, Brenda? Which is fantastic because there's all sorts of things to do after you leave the Department of Revenue and get to do with your family and whatnot. So I'm excited for you, Brenda. And like I said, I am just, again, honored to be someone that you've entrusted, your work with over the years, and to be a part of the good work that you've done here in Wyoming. So with that, Brenda, we have a mixture of trustees and folks who work at the colleges, some presidents, folks who advise the colleges. So we've got a good little mixture here, and I will be sharing it out with everybody afterwards, of course, with the slides. And if there's anything that you want to add as we go, Brenda, feel free, but you've got the run of the slides, and I'll turn it over to you. So thank you for being here today.
Hey, well, thank you so much, Erin, and you're right. I've been working in the administration of taxes for about 37 years, and we've gone through a lot of changes. And quite honestly, my perspective has always been, how on earth do taxpayers understand their tax structure? We're going to talk specifically about property taxes today, but how, is it transparent? Is it easily understood? And I think that those are some of the challenges that today, with all of the different ideas that the legislature has kind of thrown against the wall to see where they want to go with it, I think it has left our citizens with a lot of unanswered questions. And so we're really trying to take time to respond to those questions. And so with that, Erin, thank you so much. And to the community college trustees and the staff that work at the colleges, such a valuable resource to the state of Wyoming, and the growth that has occurred and the various programs that you offer, always trying to be prepared for that new industry that's going to come to town so that they have a workforce. I really do appreciate all of your efforts. But let's get going on what the heck happened. So tax relief for homeowners, absolutely a lot of tax relief. You look at other states across the nation, and everybody was looking for some sort of tax relief, because basically fair market value has been the basis for property tax across the nation, except for California, right? But that means that when inflation hit for residential properties, it hit nationwide. So many states were looking at how do you provide property tax relief. Interestingly enough, most of them provided one program of property tax relief. Well, not in Wyoming. So we're going to talk about the multiple approaches that the legislature took to provide relief on the same property. So let's get going. So you've seen this slide before. Who pays property tax in Wyoming? Now this slide changes every year, right? We saw residential property be at 31.906% for 2024. That's higher than it was in 2023. Why? Not because the residential values went up significantly. It's because our mineral value went down $2.5 billion from 2023 to 2024. And you see all of the oil production, natural gas. If you add all of those blue highlighted areas together, that was about $14.775 billion in assessed value, which that equates to almost 47% of our total state assessed value. And that's in a declining mineral market, right? But the other interesting part of that is, of that 14,775, 61% of that value is in 4 counties: Campbell, Converse, Sublette, and Sweetwater. So the rest of that mineral value, you know, we always hear people saying, oh, this up, you know, this terrible up and down swing that we've got in Wyoming for minerals. Well, those counties that have mineral production occurring, yeah, they've dealt with those up and down swings forever. But the counties that don't have a lot of mineral production, you know, take, for example, Sheridan, not a lot of mineral production there. Laramie County has about 26% last year was mineral value. They haven't seen the big swings in assessed value like other counties have. And that, of course, for the community colleges is important to know. What's your tax base, right? I mentioned the historical values related to residential. You know, for whatever reason, the legislature, I say for whatever reason, I'm going to be honest, residential property owners are the voters of Wyoming. That's why they have received so much attention. Those inflation factors that we talked about, the cost of building materials, the interest rates, all the different things that contributed to inflation, those were also impacting commercial property owners, industrial property owners. But this legislature really wanted to focus on residential values. If you look at this slide, going back to 2014, this is just a total assessed value difference from one year to the next. And that means new construction's included in there. But look at 2022 and 2023. It just hit like a brick, right? All of our residential values, you know, most of the counties went up double digits. But then 2024 came along. Now, we did have one bit of property tax relief in that 4% cap that we'll talk about a little bit later. But really, the values leveled off. So we had all of this attention, and it really was just a 2-year where we saw the inflation. And of course, you can look, Campbell County for the community college, you know, in 2022 went up 10.5%, but in 2023, 18.72%. As we look down the line, Sheridan, they saw an increase for residential of 21.38%. I mean, those are big increases. And then 18% again in 2023. So we understand where property owners were somewhat taken aback if they were simply looking at prior year value. But the reason that they're taken aback is, always keep in mind, the majority of the mills are for K through 12 education, and those are mandatory mills. So you've got the 12 mills to the school foundation, the 25 mills that goes to the school district, the 6 county mills, and then if they've got a rec mill that they assess, whatever the case may be. But those 43 mills are mandatory, and they make up the lion's share of every property tax bill in the state. Are there any questions related to these historical values? Okay, if not,
I was
go
going to
ahead.
pipe in, Brenda. I'll probably talk a lot because I'm a tax nerd, but I thought it might be helpful for you to explain, if we look at, these are residential, but if we look at, the overall assessed valuation over the years, we had, we know our valuations do this, but back in 2008, 2009, we had a huge increase. That chart though had more to do with minerals than residential, correct? So that
Correct.
this chart still didn't look that much different even then. It was more to do with the minerals with that spike.
There's a great point, and I've got a slide that sometimes I use. I didn't put it in here, but it showed mineral value going back to 2000. And it truly did. We saw the spike, as you indicated, in that 2008, 2009, and then we went down, and then we go up, and then we go down, and then we go up. But on the all other property, everything other than mineral production, it's just been a steady, from 2000, it's been a very steady increase up until we got to 2022. It jumped. It just was a spike. And then 2023, and now it's leveled off again in 2024. So even in all, and that's including residential, commercial, industrial, all your public utilities are included in that all other property. But it definitely, we had a very stable tax base other than mineral production. So we'll talk about a little bit on the property tax relief side, because one thing about it, property taxes do impact us all. And I think it is important that the community colleges, recognizing what relief was already out there. And one of those was the property tax refund program. Now, the refund program is not always funded, but it has been funded since 2021. We did not fund it. The legislature didn't fund it in 2020, but in 21, 22, 23, and in fact, we know it also expanded. So for 2023, I've provided you with the numbers. We went up an additional 4,600 applications. The reason for that is the income criteria. The maximum went from 125% of gross household median income in a county to 145%. And so we saw more applications. The other thing we saw is the dollar amount of those refunds, because the tax dollars had gone up, increased. So about $14.2 million that was refunded back to property owners for 2023. But now, this is very timely in that we're right in the midst of administering the 2024 property tax refund. And when you think about it, all of these tax relief measures that we're going to discuss, a lot of them hit in 2025. But the only relief that was in place for 2024 on residential, single-family residential, was that 4% cap we'll talk about in a minute. But what that means is this 2024 property tax refund program is as important as ever, right? So the applications, we started taking applications April 1st. They're due by June 2nd. The taxpayer can also apply at their local county treasurer's office. We physically sent out paper applications with return envelopes to everybody who applied for the 2023 refunds. So about 15,000 envelopes went out, would have been last Friday. So everybody should be receiving those. You can also apply online. We have an online portal that you can apply to. As of this morning, we've already got 500 people that have applied for that program. So I think the word is getting out there. Let's look at these median residential values. So this is on this program, the maximum refund is 50% of the median residential property tax bill for the county where your property is located. Well, look at this interesting thing that happened. So when you look and compare 2023 to 2024, we actually had 4 counties where that median residential bill is less than it was in 2023. Part of that may be some of the 4% cap, but I really think it's just tracking the marketplace. Now, when you look at the 8 community colleges, those counties, they were all, 2.82, Fremont's 3.76, Goshen 4.09, Park 3.38. So again, very similar increases to what we saw prior to the pandemic, basically. To see those percentage increases in a tax bill is reasonable. But it will mean for those counties that had a lower median residential, that means the maximum refund is going to be less in 2024 than it was in 2023. Any questions on that? If not, I'm going to jump into the House Bill 45. This truly was the first significant statute change for residential property tax relief. And it was a no application, no income or age requirement, no backfill. I would be remiss, you may recall, the property tax refund, that's totally backfilled, but the taxpayer has to pay their tax before they can apply for the refund. What I'm going to talk about going further is on the front end. And so on the House Bill 45, this was a 4% cap on the single family residential structure only. And it went into effect for the 2024 tax year. Now that bill also had associated residential land. And that means that you've got a structure on that met the criteria for the cap. And then the land that's associated with that could also be capped at 4%. That starts in 2025. Okay. I've given you an example of just the math. So basically, we take the assessors valuing everything at fair market value using their appraisal theory, the CAMA system. Sales that occurred in 2024 are used to value properties in 2025. So they're using everything that they always have. But right at the end, what they do is they say, okay, here's my last year's value. If I multiply 1.04 on that last year's value, anything above that is exempt from taxation. And they apply that exemption. And that happens before the assessment schedule ever goes to the taxpayer. There were 2 things on this particular one. If you purchased your property the prior year, so anybody who bought their property in 2024 wouldn't be eligible for the 4% cap. Also, if it's new construction or you change the footprint of your house, you added on to that house, then you're not eligible for the 4% cap. But again, that is all monitored by your local county assessor. The taxpayer is not responsible for notifying anybody on this program. But you'll see those broken out on assessment schedules, and I'll be showing an example of what an assessment schedule will look like at the end here. So that was what was put into place. And for last year, this gives you the actual. This is after the fact, after it was applied. This is the assessed value that was exempted per county. So in Campbell County, you'll see the assessed value that was exempted was $11,688,588. Now on this slide, we use the average mill levy for Campbell County of 64.30 mills to get that $751,000 approximate tax dollar amount exempted. But what I want to share with you today is for Campbell County and the 2.8 mills that they levied, that really equated to $32,728. For Fremont County, and I'm using the 5.5 mills, I'm ignoring any bond and interest in these calculations that I'm going to be giving you. 5.5 mills for Fremont County, Of that 1.7, 129,483 specific to the community college. Goshen County's 5.5 mills, 23,374. Laramie County's 5 mills, 89,876 of that 1.286 million. Natrona's 5.5 mills, 133,836. Park County, 5 mills were assessed. That's $54,006. Sheridan County, 5.5 mills, 24,547 of the 301. And Sweetwater's 5.5 mills would be $57,731. So not a significant amount. Why was it not a significant amount? It's because we weren't seeing property values appreciate from one tax year to the next. Had this been in place the 2 years prior, those exemptions would have been significantly higher. One thing I do always point out on that, when you look at that $300 million assessed value that was exempted statewide, turn your attention to Teton County, because half of the assessed value that was exempted was in Teton County. So that makes sense. Those areas of our state that are in demand, people are buying, the prices are being driven higher. They were actually the ones, those folks, you know, the Lincoln County, those folks, they saw a benefit. The taxpayers saw more of a benefit on this 4% cap. You look at Niobrara County, in total, $39,495 and $34,595 equates to $364,000 worth of fair market value. That's all that was exempted in Niobrara County for that total exemption. Why? Because property values weren't appreciating. So let's speak a little bit about 2025 and the long-term homeowners. I don't know why they're calling it the geezer exemption, but that's what I keep being told. I think Senator Case coined that phrase, the geezer exemption. So this goes into effect for 2025 property taxes, and I believe county assessors have been taking applications for this since September, because the county treasurers across the state got together and put together a uniform insert for every tax bill, not just residential. Every tax bill had an insert about this long-term homeowners exemption in September of 2024. And the deadline for applying is not until the fourth Monday in May. So again, property owner has to be 65 years or older, and they have to have paid residential property tax for 25 years in Wyoming. It doesn't have to be consecutive. You just have to show that you have paid for 25 years. And the home that you're getting the exemption on, it has to be your primary residence. You have to have lived in it 8 months out of that 2025, the prior tax year, so it'll be 2024 tax year. And the application has to go to the assessor. Now, this is the application. It's not burdensome, I don't believe. Basically, it just needs to know who is the applicant. How do you own your property? Is it in a trust? You know, how is it actually deeded to you? That's that second piece. Just because Brenda Henson is the applicant, I may own the property under Brenda Henson Trust, or it may have been my parents' trust, the Royal Trust. But the assessor needs to know that and how it's held. The age requirement, you do have to show the assessor proof of age when you apply, when you take this in. And then you'll see on the right-hand side there, it's just, tax years that you paid, and just give the assessor the address and what county it is. So for example, I've paid taxes where I live today since 2015 through current. So I would put tax year paid, 2015 to current, the address, Laramie County. That's it. You don't have to provide copies of tax bills paid, anything like that. It's simply your information. And then just, it is a sworn affidavit, so you just sign the bottom. That's it. The relief is significant. It's 50% of your assessed value for the residential structure and up to 35 acres of associated residential land. Okay. This relief is only for 25 and 26 tax years. There was a bill to extend this and remove the sunset that was considered this session, but did not pass. The other thing that impacted this exemption was language that we're going to talk about, that 25% exemption, that Senate File 69. But within the language of Senate File 69, they did clarify that if you get this long-term homeowners exemption, you're not eligible for the 25% exemption that comes into play. But there is no funding on this long-term homeowners. And quite honestly, when we were trying to put together a fiscal note for this, when it was being considered during the 2024 session, we knew that we have an aging population, but there was no way for us to know how many years those 65 and older folks had paid property tax. So our estimate was very, very low. And this gives you an idea of where we were at April 1st. So as of April 1st, we've got over 26,000 applications in county assessors' offices across the state. And of course, you know, some have more than others. The most is Laramie County at 4,364. But that was April 1st. You know, we got 2 more months for applicants to apply for the long-term homeowners exemption. But I do think, and the other piece of that is 50%. Even if we were able to determine which property owners had paid taxes for 25 years, there was no way for us to project what the value of their property was. So this was a tough one to estimate. And it's going to impact all the taxing entities. So that 26,000, if the program shut down on April 1st, we just used an estimate of 18,000 assessed dollars as an average assessed dollar figure. That's about $32 million statewide as on April 1st. So just keeping that in mind. No backfill. I just wanted to put the veterans exemption slide in here because, again, I talked about, you know, we put so many different property tax relief bills and passed them between the past 2 years. This one was passed in 2024, but went into effect for 2025. But it doubled the number of the amount of the exemption for veterans exemption. It's not going to impact budgeting for the taxing authorities because this is 100% backfilled. It cost $4 million last year for the refund program. Excuse me, not the refund program, the veterans exemption. So basically you can double that for 2025 because those same veterans are qualify, but they're going to get 6,000 assessed dollars instead of the 3,000. 3,000 with a statewide average mill levy is about $224. So this went up to 440. They did expand this for next year to include our Gold Star parents of Gold Star veterans. Those are the veterans that we've lost in service. But there are approximate, last information I had, we had about 39 of those statewide. And basically this is just allowing the parents, if that deceased service member didn't have a spouse, it allows the parents to take advantage of the veterans exemption. And so, you know, I think that hopefully we'll be able to reach out to all of those parents and provide them with this relief. Again, doesn't affect budgeting. Senate File 69, you know, this bill went back and forth and back and forth. And if there was ever a bill that we did about I'm going to exaggerate, 100 different fiscal notes. What if we did this? And what if we did that? And, you know, how would it impact the fire districts? And how would it impact community colleges? And how does it impact the counties? Because the tax base, we've already talked about that, is different depending on your tax authority's boundaries. And so there were definitely some that were going to get hit more than others on this. But it passed. It's effective for 2025. It applies to all single-family residential structures and the associated land. It's 25% up to 1 million of fair market value. So that leads us into looking at our tax formula. So $1 million of fair market value times 9.5%, which is our current level of assessment, is 9,500 assessed dollars. So, or excuse me, 95,000, and it's an exemption of 25% of that. So the maximum exemption that you can get is 23,750. And based on the statewide average mill levy, that's a tax savings of about $1,627. Property owners for 2025 don't have to do anything to receive this 25% exemption. Assessors will automatically apply it to all single-family residential structures. Again, no funding for this exemption. And that's where Aaron and many of you, we spend a lot of time talking about, okay, now what does that mean for the community colleges? Jointly, we put together the spreadsheet that looks at 2024 data for the community colleges. Who's levying what mills? Some levy the 4 mills, the additional 1 mill voter approved in some, all except for Campbell. We've got the BOCES. I want you to ignore the community college bond and interest for a moment. But if you look over to the right, I've got that 2024 percentage of residential value to total value. As you can tell, it's different in each of these counties, and it impacts. That 25% will impact differently. So the second column to the from the right, this is the 2025. In 2024, looking at all of the revenue, including the bonds and interest, what the impact would have been had it been in place. And it was a little over $6 million statewide if it had been in place. But we know that it's not going to impact the bond and interest like it does your 5 mills or the 2.88 for Campbell. So on the right-hand column, this is the loss of the tax without bonds. So it was about $5.5 million if this law had been in place last year for each of the community colleges. So I can jump back to this one, but I want to talk about this bond and principal and interest example. So I just used Fremont County as an example. So their assessed value was $851,212,824. Now this is total assessed value, minerals, industrial, commercial, residential, personal property, everything. The principal and interest payment for its tax year 2024, but fiscal year 25 was $1,024,860. How do we calculate the mill levy for a bond? It's the principal and interest payment divided by assessed value gives you the mill levy. So every property owner in Fremont County paid 1.204 mills to pay back that bond. Had Senate File 69 been in place in 2024, the assessed value would have been $761 million. The residential that exemption that would have been in place is at $90 million. So the principal and interest didn't change. The voters approved that. You still have to pay it back. So you take principal and interest divided by that reduced assessed value due to the exemption. That kicks the mill levy up to 1.347. That means that the mill levy had to go up 11.88% to be able to pay back the bond. But that increased mill levy, that's being applied again to all the taxable value, all the mineral companies, all of the commercial, industrial, even the property owners that saw a reduction because of this 25%, they're going to see a higher mill levy due to the exemption. Now, this is just only if it had been in place for 2024, because we have to consider all of the increase or decrease in values of the other types of properties when you're calculating this bond. But that's why in the slide before, I did 2 different columns. So let's stop right there and see if there are any questions related to the community college mill levies specific. Well, that
Anyone
made
have any
sense.
questions?
Can I just
I have
ask?
one.
So,
Oh, I'm
go
sorry.
ahead. Go ahead, David.
Yeah. Aaron, my question is if there's a reduction in this particular, let's take Natrona. So if there's a reduction and we'll use the 1.25 million, is that a direct loss to the college? I mean, and I don't understand the full funding model for the colleges. So if there's a reduction in property tax of that amount, I understand that's less money coming locally. Is there any way that's made up in how the funding model is put together, or is that simply, is this the number we should understand that we're going to see as less funding to the college?
I think, Trustee Applegate, I think I'm gonna turn this over to Brenda. But how we talk about this in terms of the funding formula, let's just set aside the bonds and interest right now, but all the dollars that are generated from property taxes locally stay in your county. So you're just impacted by the reductions from all of the things that Director Henson has talked about. The redistribution formula impacts the state aid. That could change though, depending on how those local mill levies, change among the colleges and who gets what percentage of the pie. But everything that you generate in your county stays. So it could redistribute the pie a little bit. I wanted to ask Director Henson with regard to, does that help answer that question, Trustee Applegate?
Yes.
And we can get into that some more.
Yeah, thanks. I mean, you answered it in the sense that we do lose that local tax, but there could be some change in how the overall model works, but wouldn't make up for that difference, obviously.
So Aaron, you're much more knowledgeable about the funding models outside of property tax. I will say that this is a snapshot of 2024. So where we're at, this is April of 2025 tax year, which is your fiscal year 2026. So a lot of moving parts happening. And so county assessors right now are appraising property, applying all of these various exemptions, and getting assessment schedules out. They have until the fourth Monday in April to get those out. Property owners have 30 days to appeal or at least go in and visit with the assessor, make sure their property characteristics are listed accurately. So that occurs through May. By June 1st, county assessors have to have an abstract to the State Board of Equalization. The State Board of Equalization either approves the abstract or sends it back to the assessor to fix whatever they think needs fixed, but that very rarely happens. So typically, the county assessors got values. The Department of Revenue is also responsible for getting values to the counties by that June 1 time. The only thing that comes in a little bit late are the values for railroads because they have a later reporting date in statute. So we typically don't get the railroad assessed values until later in June. But the reason I'm telling you this is mid-June, your county assessor will be able to tell you what your 2025 tax year assessed values are for each of your community colleges. The other thing they're going to be able to provide to you is a report that tells you exactly to the dollar how many assessed dollars were for the 4% residential structure cap, the 4% associated land cap, the 25% homeowners exemption, the long-term, the 50% long-term homeowners exemption. They're going to be able to tell you exactly what that loss was based on last year's mill levy. We've provided them with those reports so that they can provide those to you. I get that June is a difficult time period for that information. It would be nicer if you had it earlier, but our tax calendar just doesn't provide for that. But that being said, you may see a reduction in one area based on all of these exemptions, but until you know your mineral values for some of the counties, how do you know? I mean, you may still have a positive assessed value from last year to this year, even with these exemptions. We just don't know yet. And so those are important. Like I said, veterans exemption, they can give you those numbers, but it's not going to impact you because those are backfilled. So don't have to worry about that. But the other moving part, and we won't get into the weeds, but the monthly ad valorem mineral estimated tax. As you all know, in 2022, that's when we first started sending all of the taxing entities. Well, we send it to the county treasurer, and then the county treasurer distributes it based on the prior year mill levy. But we started sending you on the third month following the month of production. Those producers had to pay an estimated property tax. And so that money was coming in to all of the taxing authorities, with a reconciliation occurring in September of the following year, because property taxes, when we really look at ad valorem property taxes, for example, 2025 property taxes, the mineral values are 2024 production. So in January of 2024, we were using a 2023 mill levy to estimate all of that tax amount and collect the money, send it to the county treasurer, they distributed it. Okay, that's the money that now we'll certify after reconciliation here. When we certify the 2025 mineral values to the county assessor and they're included in the tax roll, it's at that point in September that the treasurer has to reconcile and say to the taxing entity, okay, I give you too much money. You're going to have to, we're going to either withhold from future distribution, or perhaps you didn't get everything that was owed by that producer, and the treasurer sends out another bill, and as soon as they pay that, then they distribute that to you. But I think it has truly made the money flow. I mean, yes, the entities are getting the cash in a more timely manner, but on any given distribution, I'm sure that all of your accountants are going nuts, because they may see 3 different tax years money on the same check from the county treasurer. And, you know, that's another topic. There was legislation that passed this session that allows the county treasurer that if, let's say, a community college had a bond and the mill levy in 2024 satisfied that bond, okay? The statute requires the Department of Revenue to use the prior mill levy for that tax district to do an estimated tax. Because the treasurer knows the bond's paid off. In 2025, I don't need any money. So what I'd like to do is hold that money. I don't want to distribute it to the taxing entities, including a community college, because I know I'm just going to have to ask for it back because they're not going to levy that mill. And so that bill did pass, but that is definitely going to take a coordination between your local county treasurer and the taxing authorities on how that works. Questions on that?
There's so much to it, right? And Brenda, thank you for walking through all of that, because that kind of tees up what I was going to say is, I know that all of the folks at your colleges who work directly with the county assessors and whatnot, they are all meeting on Friday with the commission, with the new CFO at the commission, to look at how all of these moving parts, you know, fit together. Because if you're a county with minerals, those monthly payments impact you and have already, you know, some of your schools have impacted what that looks like. If you're a college that has high valuation of residential and not very many, not much in minerals, you know, your picture looks a little bit differently. And how the redistribution model fits into all of that is kind of the big question. So there's a lot to say that so many variables and how it all fits together doesn't necessarily match up with the tax year or the tax deadlines either. So as you set your budgets, I think this year is going to be we're going to do our best. We're going to try and have as much information as we can. But this is going to be a big learning year for everybody, I think.
Yeah, and as we learn and we just get it figured out, then we're gonna jump. These are those percentages, they were on the prior slide too, that just say, you know, what are the percentages of residential value in each of the counties for 2024. But as I started to say, we're just gonna get it figured out for 2025. And now Senate File 69 takes a switch on us, okay? So that bill now says that in 2026, that 25% exemption is only going to apply to owner-occupied structures. Well, the catch there is we've got 230,000 approximate single-family residential properties in the state of Wyoming. Based on census numbers, we know about 72% of those are owner occupied, but we don't know which one. The county assessor has no idea if the owner of that property actually resides in that property, or if it's a rental, or, you know, if their son lives there. No one knows. And so the owner is going to have to notify the assessor. And what we're working on at the Department of Revenue, we recognized early on to have county assessors taking a hard copy application or taking on this notification process. I mean, we're talking 170,000 people reaching out to a local county assessor's office to say, yes, I live there. That's significant. So what we're doing, and we've almost got it built, we're working with the county assessors to design an online application where any owner that pays property tax can go on to one site. We'll have the address that we can put in a tax bill at the end of this year, where they can say, I live in Fremont County. This is my address. It's actually intuitive. It'll go out and search for that address. See if the name matches. You know, is this your property? Yes. Do you reside there more than 8 months out of the year? Yes. You'll be able to apply online. And then right before assessment schedules go out, the assessor will download that file and apply the 25% to everyone who's notified. Now, interestingly enough, this bill didn't have any of the administrative aspects in it. It just simply said, this is the 25%. So what I'm saying is, the law doesn't say when the deadline is for applying for this. Now, what we do know is they have to have an abstract to the county, or excuse me, to the State Board of Equalization by June 1st. What we envision is promulgating rules that will probably be, you know, we haven't decided if there's going to be a 4-month period where property owners can notify through this website, or if it's just going to be 2 months. We know they have to own it on January 1 of 2026 in order to be eligible for for this exemption. So, you know, it has to be before the assessors turn in the abstract, but after January 1st, so that we know they own it. But this is going to be a significant lift. And then when we look at how it's going to impact your revenues, again, every county's demographics is different. So for the 2023 census, Sweetwater County is 73% owner occupied. Sheridan County, 69%. Goshen County, 75% owner occupied. So that 72% statewide that I talked about, it's different. You know, look at Albany County. Only half of the properties in Albany County are owner occupied. So 80% in Converse. So these mean different things. 90% in Weston County are owner occupied. So we'll see how that goes. I mentioned I was going to give you a glimpse of what the 2025 assessment schedule looks like. Very similar to prior years, but hopefully will explain exemptions to the taxpayer. You're still going to see the prior year assessed value. So in this particular example, and I used a property that was in excess of $1 million in value, so we could see how that up to $1 million cap worked. So last year's value on this property was $1,344,426 in that upper left corner. You apply the level of assessment to get to assessed value, last year's mill levy. That means that last year's tax was $7,959 without any exemptions. Okay. This year's current assessment, this is where the main reason for this assessment schedule, so a property owner can look at this year's value, in this instance, the $1,345,152, and say, does that make sense? Do I think my property is worth that much or no? And if I think it's not correct, I need to reach out to the county assessor within the next 30 days. But the notice will give you an estimated tax based on the prior year mill levy. Now we talk about exemptions. On this particular example, on the residential, for that residential exemption is that 4% cap. Okay, so that means that on just the residential structure, when we did the math, the assessor appraised it 1.04, and then anything in excess was exempted. In this example, it was $1,999 of assessed value. The homeowner's exemption, 25% up to $1 million. It's capped at that $23,750, right? And so otherwise, if there was no cap, then you would look at that residential structure and do 25% of the $107,929, which would be a higher value, but it capped at $1 million. This particular property has the veterans exemption. So to the right, 2/3 of the way down, you'll see the estimated tax using prior year mill levy, $7,964, without exemptions. On this particular property, estimated tax using prior year mill levy with exemptions, $5,984. Now, if this particular owner applied and qualified for a long-term homeowners, let's say they get this assessment schedule, they apply and qualify for long-term homeowners, they would get a different assessment schedule, a follow-up or amended assessment schedule that removed the homeowners exemption of 25%, but added the 50% exemption. And the statute does allow for the cap and the 50% to be applied to the same structure. Any questions on the assessment schedule? And I believe some of our, at least a couple of our assessors have already mailed those out. Laramie County's went out yesterday, so be looking for those in the mail. I would be remiss if I didn't talk about two other exemptions that are going to impact you in 2026, which is your fiscal year 27, and that's business personal property exemption. Senate File 48 gives $75,000 of fair market value exempt for businesses on their furniture, fixtures, and equipment per company, per county. This is going to impact everybody differently based on the tax base. We estimated about 8.8 million statewide on this one. So the process is still, every business owner still has to report their business personal property. The assessor has to value that personal property before they know how much that is the fair market value and how to apply the 75. So personal property declarations will still go out the first of the year. They have to be back by March 1st. The assessor sends out a notice of value. If the value for the company is $75,000 or less, they won't see a tax bill go out in September. This is going to cost the taxing entities. It is not backfilled. Senate File 49, this is more geared towards the appraisal of personal property, and it benefits the older assets, those pieces of equipment that companies purchased 30 years ago. The way the appraisal process works is we take that historical dollar and we trend it to today's dollar, and then we depreciate it based on the type of equipment it is, and then we put a floor of 20% on the depreciation. This basically says once it hits the 20% floor, that you can't trend anymore. So you know, if we trend the dollar for 15 years, and then it only has a, 15-year life, we won't be trending that dollar anymore. It really does a lot of impact for our oil field equipment out there. We've got a lot of older oil field equipment, but estimated fiscal impact 33.5. This has a bigger hit for those counties that have mineral value because they have the older equipment. Your technology companies, those kind of companies that are replacing those computers and servers and, our data processing centers, they're rotating that. So this depreciation and indexing bill is not going to impact them much. But it's just something I felt important for you all to know, that it is just another piece that is reducing the tax base that you have the ability to levy on. With that, that is everything that I had for information. We took longer, but I like the discussion while we're going through. But it's 12 o'clock, Erin. We can't.
I just did it, didn't I? Sorry. Kathy, I see your hand up. Trustee Emmons, do you have a question?
I do, and I'm sorry if I missed this, but can you have the veterans exemption and one of the other exemptions? Okay, thank you.
Kathy, you can.
Thank you.
Yeah, the veterans exemption is on top. You may recall also House Bill 279 was a bill that, with all of these exemptions being applied to the exact same house, we needed some clarification to ensure, where were we putting, were we applying the 25% and then applying it, any other exemption. But the veterans exemption, it's backfilled. So you don't have to worry about it in the budgeting process for the community college. But yeah, the veterans exemption, you can always use that. Now, we believe that, depending on how they go down the road on some of these exemptions, there could be a time that your property taxes are very low. Keep in mind, you can use that veterans exemption on motor vehicle license plates as well. It's not worth as much money because it's 6,000 assessed dollars. And if you do 6,000 assessed dollars on, let's say, 70 mils, it's worth a lot more money to you. For motor vehicle license plates, the mill levy is only 30 mils. So it is worth a lot less to you as a motor vehicle. But we do have veterans that they don't own real property and they simply use it on their vehicle.
Thank you for that. Any other questions? If anyone has another question, please feel free to raise your hand. What I thought I would mention is that the Joint Revenue Committee will continue work on property tax issues this interim. I'm not exactly sure where they want to end up because we had, lots of other ideas, acquisition value, things like that, that were bills this session that didn't pass. The ultimate, and we've heard some legislators say we want to get rid of property taxes altogether, which, a lot of people, and if you know, which you all do know, how, what property taxes fund and how it works, that would be a fundamental shift in how things work around here. And we would have to significantly change our tax structure if that were to happen. So lots of more.
Real quickly, I also wanted to add is I do think that when they make those statements, I believe that they're totally focusing on residential. I don't think that they're recognizing the taxes that commercial and mineral production and, when they say, let's get rid of property tax, for commercial and industrial properties, we're the most tax-friendly state in the union currently. But when they make this broad statement about eliminating property tax, I really think that the majority of them are just thinking about residential. And I would be remiss if we didn't mention Amendment A on the ballot last year,
Right.
that the voters voted and
Right.
said, we want to use this tool. And unfortunately, they didn't take any action with that. And I would hope during the interim that look at that tool, because That's constitutional. There've been some questions about a cap and whether it's really constitutional and if it could be challenged. But now with the amendment and with the voters, they spoke and said, we want residential to, the legislature to be able to lower that amount. We want them to be able to do something for owner occupied. All of that can be done pursuant to the Constitution, and you could eliminate some of all these exemptions that they've got on the books. So I hope that that conversation is done. I know that they asked for 6 days. I don't know if Management Council will grant Revenue Committee 6 days. I know they want to limit to 4.
Yep, you're right. A lot of big conversations to happen in, who knows how much amount of time. So that's still to be decided, but you're right, Brenda. Thank you for bringing up Amendment A. That's important. And I just, we're not done yet with all these conversations. So WACCT is going to do what we can to make sure we provide information. We've got property tax resource on our website. Director Henson and all of her folks, the assessors, so many people are willing and to help. And so we're going to continue to keep those friendships and relationships open so that we can make sure that you guys have the information that you need. So with that, I think we'll wrap this up. And like I said, we'll share the slides. And I know that I'll see many of you next week in Gillette for commission meetings and WACCT meetings. But Director Henson, thank you so much. Appreciate it.
Thank you.